5 stocks to outperform the S&P 500. We're going to use a stock market screener, and this is going to be based on 2 fundamental metrics. Now, to get to this metrics, the reason that we have gone through this is using the magic formula from Joel Greenblatt's book, The Little Book That Beats the Market. And essentially, he's an investment manager, a fund manager who started his own company in 1985 and had 40% annual returns for a duration of 20 years. Now, we are using this stock market screener, essentially finviz.com. If you want to use it, you can play around with the different screeners based on your own metrics. So he said that he used these 2 metrics to outperform the S&P. The first one is the return on assets. So essentially, you want a very high return on your assets, as well as a very high earnings yield, which is essentially the inverse of the forward PE. So today we're going to run through 5 of the best stocks that do come from this screener. We're going to take a look at the valuation of each one, getting to the intrinsic value as well as the acceptable buy price, and look at those financial metrics as well as the dividend safety. So as we can see here, we have done a return on assets over 20%, forward PE under 20, and we've selected 5 of the best ones from the top 10 and ordered them in terms of largest market cap to smallest. So the first one that we are looking today is AMAT, Applied Materials. Now, over the last year, it has had some strong performance, up 39%. 52-week range, it is to the mid to upper end of this period. We can see a forward yield of just under 1% and a forward P of 19.5. Now, if you've been holding this over the last 10 years, you would be up a phenomenal 754%. Bear in mind that doesn't include those dividends reinvested, but still absolutely incredible. And we can see its all-time highs towards the beginning of 2022 at around $167. So dividend safety score is sitting at 86. It is very safe. A market cap 125 billion. So let's take a look at those recessionary metrics for those that see a recession inbound. Well, they maintained the dividend during the 07-09 recession, below average growth of negative 38% versus the S&P's negative 12%, and a near enough return versus that S&P of negative 57%, with the S&P bringing a negative 55%. Dividend growth, lots to love, 23% in March 23, so we are expecting another increase in a few months' time. 12% over the last 5 years, 12% over the last 10 years on average, absolutely phenomenal, and they have been increasing those dividends for the last 6 years. So let's take a look at dividend yield theory. As always, it states a company is undervalued when the current yield sits above the 5-year average. So we have a sign here of some slight overvaluation, 0.85 versus 1.02. Forward P 19.5 versus 16.3, but as always, we will not look at any of these models in isolation and draw our conclusions towards the end. It is in fact lower than the sector P of information technology at 24.5. As always, for those viewers that are new, we do ignore earnings data. It is susceptible to manipulation by management through accounting. We focus on free cash flow. Now, personally, I like to see 60% or lower. You can bring this down to 50% if you want to focus in on the semiconductor industry. And we can see for the large part, it has in fact been below 50%. 2023 at 13%, 2024 expected 17%. Does show us that that dividend does look likely to increase by double digits continuously over the future period. Free cash flow per share, very nice to see the increase, 128 in 2014, 904 in 2023, so it has increased at a very fast rate, although do note the inconsistencies, some periods of saying essentially flat or a small decrease, but over the longer term, some incredible growth. Now, when we focus on sales growth, as always, 3 to 7% is our target at a baseline minimum. Double digits is positive to see, and we can see for the larger part of the company's history in the last 10 years, it has been double-digit growth, although 2023 did come in at the bottom of what we expect at 3%. So numerically, we can see the top line has grown quite substantially from 9 billion in 2014 to 27 billion in 2023. On top of that lovely dividend growth, they're doing a lot of share buybacks, returning excess cash to investor pockets, 1.23 billion in 2014, 845 million in 2023. ROIC then, remember we want 10% or more, gives us faith that management are able to effectively allocate their capital, and we can see not only is it 34%, which is very strong in 2023, but it has also been increasing over the last 10 years, which is a positive sign and helps us effectively have faith in management. Free cash flow margin, operating margin, very strong above both the minimums on the operating as well as the free cash flow. Very, very positive. They are a free cash flow machine. 29% free cash flow margin just this year. Very, very strong. And finally, one of the best metrics that I like to look at, the net debt to EBITDA, earnings before interest, tax, depreciation, and amortization, shows the number of years it would take the company to pay off all of their debt net of cash on hand. And we can see these are the number of years. It shows us, one, the balance sheet strength, and two, the dividend safety. It wouldn't even take them 1 year or 1 day, in fact, in 2023 to pay it all off. Absolutely phenomenal. A very strong balance sheet. That dividend does look to be secure. Now we jump into the valuation. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And typically on the channel, on the deeper dives, we do run through each model, getting to the intrinsic value towards the end. But for today, we'll jump straight into the intrinsic value calculation, which is the average of the 4 models you see on the screen. For AMAT, it's coming to $195 with a current price of around $150. We start off with a 10% margin of safety, and we use that if we believe it has a wide moat, strong financial metrics, good forward-looking data. We keep extending that until we see it comes to essentially a sell. So at 25%, we can see it isn't quite there yet. So we believe right now it is around a 20 to 25% margin of safety. In terms of Wall Street and what they believe, we can see that they believe there to be around a 15% upside, or 10 to 15 over the next 12 months. So in conclusion, for AMAT, we see around 20 to 25% margin of safety, with Wall Street expecting around 10 to 15% upside over the 12-month period. We then move on to the second stock, which is WSM Williams-Sonoma. Now, the last year we can see strong performance, up 58%. It is trading towards the mid to upper end of the 52-week range, with a forward yield of 1.82% and a forward PE of 13.6. Now, if you've been holding this over the last 10 years, you are up around 267%, and we can see the all-time high at the back end of 2021 at around $215. Dividend safety at 80, it does look to be safe. Market cap $13 billion, a large cap company. Now, when we look at those recessionary metrics, they maintained the dividend during the last recession, below average growth, and also significantly trailed the S&P with a negative 76% return. Dividend growth, very nice to see, 15% in March last year, so we're expecting another increase in a couple of months. Double digit, 15% on average over the last 5 years, 13% over the last 10 years, lots of positives to take, and they have been increasing those dividends for the last 13 years. In terms of dividend yield theory, we can see here the sign of overvaluation, with that current yield sitting below the 5-year average, but we do see the forward PE near enough the 5-year average of 13.6 versus 13. And if we want to compare it to the consumer discretionary sector PE, Williams-Sonoma is sitting slightly lower. So let's take a look at that free cash flow payout, and we can see it has been below 60% consistently, and 2023's 30% does look positive. Now, when we look at the free cash flow per share, $2.69 in 2014, $10.30 in 2023, and expected to go to around $15 in 2024. Very positive, but again, always understand these companies aren't those that continually rise every single year. We can in fact see a period of remaining fairly flat towards the beginning of the data we're analyzing. Sales growth then, not bad over the last 10 years. 21, 22's nice, strong double digits. 23 at 5% is also fairly positive. So it is good to see these numbers when looking at the revenue of Williams-Sonoma. And if we look at it numerically, they've essentially doubled their top line over the period, 4.4 billion to 8.7. On top of that, shares outstanding continually decreases year on year, which is very nice to see as an investor. Just under 100 million in 2014, 69 in 2023. ROIC then, very strong, double digits year on year. In fact, the last 2 years near 50%, which is absolutely phenomenal. It is something that is very, very positive to see as an investor or a potential investor. Now, we have noted their operating margin hasn't been the greatest over the last 10 years, but notably over the last 3 years, they have picked this up and it has started to considerably increase from the prior years. That is a big positive. And we can see consistently the free cash flow margin is well above that 5%. Although do note 2023 at 8% is still very positive, but the prior 2 years we did see some strong double digits. Net debt to EBITDA then very strong as well, 0.52 in 2023, well below the 3 maximum we look for. So they do have a strong balance sheet, and that dividend does, again, similar to AMAT, look to be safe. So let's jump into the valuation, and don't forget you can click on the pinned comment below where you can grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies on your watch list or even those in your portfolio. So margin of safety, we start off with 10%. It looks to be a buy up to 239, at 15% up to 225, 20% up to 212, 25% still a buy, pretty much there or thereabouts the current trading price. So a 25% margin of safety. In terms of Wall Street and what they believe, in fact, this is a stock that they do believe has downside. They don't see this price increasing over the next 12-month period, which is fairly interesting. It is probably one of the first or one of the few we have reviewed on the channel. So do let me know your thoughts, especially if you are a shareholder of WSM, whether or not you concur with Wall Street. So in conclusion, we see around 25% margin of safety based on our estimates and judgments, with Wall Street in fact seeing downside. Moving on to company number 3, we have LNG, Chenery Energy. Now this is one that the last year they are up around 14%. It is trading towards the mid to upper end of the 52-week range with a forward yield of just over 1% and a forward PE of 4.5. Now over the last 10 years they are up around 261%. And when we take a look at the dividend safety score, it sits at 60, borderline safe. Market cap just under 40 billion, a large cap company. In terms of recessionary metrics, well, they didn't pay a dividend during the last recession and had below average growth of negative 18%. Their latest dividend increase, very nice to see, double digits, 10% in October 2023, and they've only been increasing those dividends for the last year. So let's take a look at dividend yield theory. We can see a sign here of reasonable valuation of 1.04 versus the 5-year average of 1.01. And the forward P to DCF ratio is there or thereabouts to the 5-year average of 10.6. Now, when we look at the energy sector PDCF comparison, it is sitting at 7.5, significantly lower than that of LNG's 11.4. So let's take a look at the essential DCF payout ratio, which is a much better use to analyze as the free cash flow is a lot more volatile for these pipeline companies. And we can see it is significantly lower, and that's not surprising given how low the yield is currently for an energy company. 2023 is expected to come in at 5% once that annual report is released. So let's take a look at the free cash flow. In fact, the DCF per share now $2.57 in 2017, $34.40 in 2022. Some strong increases over the last few years. Although do note 2023, whilst it is expected to be lower than 2022, it is still sitting significantly high in comparison to the previous years. Now when we take a look at the sales growth, we can see double digits. Some years are very, very strong, although note 2023, it is expected to drop negative 24%. And numerically speaking, it has gone from around 1.29 billion in 2016 to 33 in 2022. Now, it is fairly typical with pipelines, as it denotes here. They do retain little of that cash due to their costly growth projects. So we do see they have diluted your position as a shareholder over the last 10 years. Maybe not at the quickest rate that you would expect, so that is fairly positive. But it is interesting just to note that they do dilute your position, especially when we don't consider this industry significantly on the channel. ROIC then we can see fairly mixed, some years negative, some years very low single digits, 2022 at 16%, 2023 at 23%, also worth noting the cyclicality and volatility of the industry. And that is shown here again on the operating margin, a few years of negative followed by positive and then negative. So something just to consider and understand when you are investing in different types of industries. Net debt to EBITDA then 2022 at 2.22, below the 4.5 maximum, 2023 at 2.16, again expected to be below that and slightly lower than the previous year. So it does look like that dividend should be safe for now, especially when we did look at the payout ratio as well. So let's jump into the valuation of this company, and we can see the intrinsic value is coming to $231. Now with the current price at 167, margin of safety as always at 10%, it screams a buy. At 20% still at 184, 25% we can still see that, and if we go to 30% it isn't a buy just yet. So it has around a 25% margin of safety, and when we compare that to Wall Street, they also do see some upside on this stock over the next 12-month period. So in conclusion, for LNG, whilst we see around a 25% margin of safety based on our judgments, Wall Street are expecting 25% upside to this stock. So do let me know your thoughts and comments as we go along, whether or not any of these you've either invested in or on your watch list or interest you for a deeper dive. Moving on to company number 4, we have ULTA, Ulta Beauty. Now this one over the last 10 year, or over the last year in fact, is down around 1 to 2%. Over the last 10 years, it is up around 474%, with the all-time high at the beginning of last year around $551. It is trading in the midpoint of the 52-week range, forward PE of just under 19, but do note this company doesn't currently pay a dividend. So market cap 23.4 billion. It is a large cap company. When we take a look at the free cash flow per share, 159 in 2014, 22.80 in 2023. So some strong growth over the last 10 years. Very positive to see. 2024 expected to go even higher. So when we look at the sales growth as well, lots to love here. Double digits every single year. We do see that COVID year down 17%, so there is no surprise. It can be well justified. And even in 2022 and 2023, still very, very strong. So numerically, their top line has gone from around 2.7 billion to 10.2. On top of that, they also do share buybacks. They've reduced shares outstanding from 64.5 million in 2014 to 52 in 2023. Now, ROIC, absolutely love this. Very, very high, consistently over the last 10 years. 2023 coming in at 42%. It is very positive to see as a shareholder or a potential shareholder. Operating margin, would like to see around 16% consistently. Given 2023 did come in at 16%, I would like this to stabilize or at least be the bottom of the operating margin. Free cash flow margin, very positive, and also note that it has been increasing over the last 10 years. Finally, net debt to EBITDA 2023 at 0.51. Absolutely incredible to see as an investor. It does give you faith that that balance sheet is strong, and if they do at some point start paying out a dividend, it would look to be safe. So that's absolutely great to see. And do bear in mind, when we do review companies, do write down or do note what we are regularly seeing with very strong high quality companies: low net debt to EBITDA, high return on invested capital, high free cash flow margin, high operating margin, so that when you do analyze your own companies, you are effectively making sure that they do hit those criterias. And do let me know if you want, I can go into that in a bit more detail. So let's take a look at the valuation of ULTA. And as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified and these videos drop on your doorstep as and when they're released. Also lets me know you enjoy this type of content so I can start pushing out more of what the community loves. So current price at 485. If we start off with a 10% margin of safety, it looks to be a buy up to 559. At 20%, around 496. And at 25, not just yet. So right now, we believe there is around a 20% margin of safety. In terms of Wall Street and what they expect, well, we can see over the next 12 months, they do see the price to go around to $555. So in conclusion, we see around a 20% margin of safety, with Wall Street expecting 15% upside over the 12 months. Moving on to stock number 5, we have ATKR at Corey. Now, this is one that last year we can see it is up around 27%. Over the last 10 years, we can see some strong growth, and when we analyze the last 5 years, up 590%. It is in the mid to upper end of the 52-week range, with a forward PE of just over 9. Now let's take a look at the financial metrics. Market cap 5.7 billion, a mid-cap company. And when we analyze the free cash flow per share, we can see some strong growth, $1.22 in 2014. $15 in 2023. Absolutely incredible. Very, very strong. Nearly 15 times growth on that free cash flow per share over a 10-year period. Sales growth, a bit more bumpy and inconsistent. We see some years of strong double-digit growth. We see years of negative growth. And 2023, the latest annual report, showed a drop to 10% to the top line. And if we look at it numerically, it has still grown more than 2 times over the 10-year period, from 1.7 billion to 3.5. Shares outstanding, they do share buybacks, but they also issue shares. The positive thing to note is over the last 10 years, the net position would have been shares being bought back, going from 51 million to 39 million in 2023. ROIC, very nice. Not only is the more recent period very high double digits, but it has been increasing from 2014. Give me a good sign in management that they are improving the efficiency of the business. 38%, very positive to see that in 2023. Operating margin, very nice to see again, a very similar story. It has been increasing over the last 10 years, and the last 3 years, very positive to see, between 25 to 32%, and the same can be said for the free cash flow margin. So this does look like a company that efficiencies are improving in the more recent period. And as I mentioned before, these are common themes with very, very strong high quality companies. One of them here being the net debt to EBITDA being very low at 0.47 in 2023. So let's jump into the valuation, see whether or not we believe it to be undervalued and what margin of safety we can gather. And don't forget, you can click on the pinned comment below to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or watch list. So margin of safety at 10%, it is a buy up to 225, at 20% up to $200, at 30% up to 175, and if we go to 40%, it is pretty much $1 shy. So right now for ATKR, we are seeing around a 40% margin of safety. In terms of Wall Street and what they expect, we can see some nice upside to $187, which signals around 25% upside. So in conclusion, 40% margin of safety based on our estimates and judgments, with around 25% upside per Wall Street and their targets over the 12 months. As always though, do let me know your thoughts in the comments below. Are any of these companies ones that you had on your watch list, ones that you were looking to buy, or whether they're new companies that do interest you? Let us all know below. As always, if you've enjoyed the content, smash that like button, hit the subscribe and bell button. Let these videos drop on your doorstep as and when they regularly arrive. And don't forget, let me know your thoughts below, and also click that valuation link if you want to grab a copy. As always, have a great day, catch you on the next episode, and take care.